I'm going to keep my comments relatively short and start with putting some of the last year into perspective from a financial market point of view. What we can see in this first chart is how global equity markets have tended to recover from previous bear markets going back to the 1970s. That's shown in the black line. The red line is showing what happened around the financial crisis with the trough in 2009, and the orange line is showing what's happened this time around. And it's pretty clear that we have had a unique and extremely powerful recovery in risk assets like equities from the bear market last year. Even more remarkable when you consider that globally equities fell only around 30% during the worst part of the corona pandemic, compared to around 60% during the financial crisis. You can see that at around this time after the financial crisis, there was already quite a big pullback in equities. That marked the beginning of the European sovereign debt crisis. We haven't had something like that happening this time around. So equities have really recovered their losses. At least in developed economies, they're at new all-time highs. Now, why has it been so strong? Well, a lot of it has to do with, of course, policy support. You mentioned that in your introduction. Interest rates are at an all-time record low. We've seen the restating of quantitative easing in many countries. And you can see that US financial conditions, a broad measure of monetary policy, is looser now than we've ever seen before, much looser than it was even after the financial crisis. And of course, we have also seen many governments stimulate their economies through easier fiscal policy as well. So where does that leave us in terms of equity valuations? Well, one of the potentially concerning issues for investors as we move forwards in time is that we're really starting this cycle with very high valuations. And we can see here the value of equities globally relative to world GDP, much higher now than it was even before the financial crisis, or indeed before the collapse of the technology bubble at the turn of this century. We do expect this ratio to come down as the economy begins to recover, but of course it does leave us with some potential concerns about how far equities can move from here. Now, on valuation though, I think it's also important to say that if we look at many different valuation metrics, and this table shows a selection of them for the United States on page 7, you can see that most valuations are very high. The column there shows the percentile of these valuations relative to history. The higher it is, the more extreme valuations are. Equity valuations are very high, but it's true that also the valuations of government bonds are very high, and so are credit markets. So I think a challenge for investors is that we're starting a cycle with very high valuations, probably meaning lower longer-term returns. But it's important to also emphasize that the one valuation metric which does not look very stretched is the one that says the ERP, the equity risk premium. And this is an important relative support for equities compared to government bonds and other kinds of competing assets. And we can see this here on this next slide, page 8, which is showing what's happened to bond yields in the US over time and what's happened to dividend yields. The dividend yield is the dark line. And I think it's important to emphasize that since the financial crisis in 2009, government bond yields have come down a long way. They've fallen from around 4% to a little over 1%. But over that period, dividend yields haven't really changed very much until the last year, as investors have repriced equities in the hopes of a strong economic recovery. But while the PE ratio, the absolute valuation of equities, is high, almost as high as it was back in the late 1990s, the relative valuation is very different. For example, in the late 1990s, investors were so confident about future growth at that time that they were prepared to buy equities yielding around 1%, when the risk-free rate, the government bond yield, was about 6.5%. Today, we have a dividend yield of around 1.5%, even more when you add the share buyback yield. But the risk-free rate is only around 1.5%. So this relative derating of equities over many years has reflected concerns about longer-term growth and the tail risks of deflation. And we believe that as this cycle progresses into 2022, the threats of deflation will moderate and there'll be more focus on inflation. And that will help to bring down the risk premium and at least allow equities to outperform bonds. Here you can see for the US, Europe, and Japan, a comparison over time of equity risk premia. The higher these numbers are, the cheaper equities are relative to government bonds. And you can see in the last year, these have started to moderate as fears of deflation have reduced and hopes of a stronger economic recovery have come through. We think this has further to go. And that should mean that while absolute returns in equities are lower in 2022, they do better than government bonds and corporate credit. It's also important to say that earnings revisions have been really quite strong, particularly in the US and Europe. And in fact, we've seen very robust recovery in corporate profitability. And many markets have actually seen their price increases being less than their earnings increases. So PE ratios have actually started to come down from these very, very high levels. When we look forward into 2022, I think it's important to emphasize that profit growth is going to be less than we were seeing this year, as we've seen earnings recover very sharply from their losses during 2020. But also, I think it's worth mentioning that next year, 2022, we think the actual growth rates of profits will be generally stronger outside of the US than in the US. And that is rather unusual because, at least in the last decade, US earnings per share, US profitability has grown generally much stronger than that of other regions. Now, there are a couple of reasons why this strong growth in expected economic activity is also driving strong flows into equity markets. And you can see that while the US has seen the bulk of those inflows since the start of the pandemic, that's the light blue line, other areas are also starting to see a strong recovery in flows as investors start to look at the prospects, not just of economic recovery, but of profit recovery in the other regions of the world. What are the risks? Well, there's a couple of things just to emphasize, in particular in the US, and one of the reasons why profit growth will be lower there than other areas next year is that taxes are rising on the corporate sector. And this just shows the effective tax rate of the corporate sectors around the world. And you can see that the US currently is very much on the left-hand side here. It has very low effective tax rates, close to those of Hong Kong and Singapore. But as taxes rise, it's likely to have a negative effect on profitability, reducing earnings per share next year by several percentage points, so that we see only around 2% earnings growth. The other risk, of course, is that in the US market in particular, as well as in China, we have very heavy concentration of the index in a relatively small number of companies. And this chart is showing that concentration. The lower the line, the more heavily concentrated the index is in a small number of companies. And obviously anything that negatively affects those small number of very large companies can have a big impact on the index. We've seen that already this year in China as a result of the derating of the internet sector. And of course, it is a risk as we move forwards with higher taxes in the US that this has a negative impact there. Finally, let me just say that one of the risks that's most prominent to focus on over the next year or two is inflation and bond yields. The reason I say that is because this chart is showing how prices have changed across a number of different measures since 2009. And what we can generally see is that on the right-hand side, we have different measures of inflation in the real economies. So things like consumer prices and house prices, commodity prices, wages, they've all seen very, very modest increases since 2009. It's been a very disinflationary environment. And it's that disinflation that's allowed bond yields to come down to such low levels. But the result has been very strong asset price increases. You can see those on the left-hand side with equities and credit performing extremely strongly, with most of those gains being in long duration assets that have the most benefit from lower bond yields, like the NASDAQ and the S&P. Of course, if we do start to see inflation really taking hold in the real economy, and that eventually pushes up bond yields more dramatically than we've seen so far, this could cause all financial assets to derate, with those with the longest duration having the most risk in that environment. So I will leave my comments there and hand back to you. Thank you.